Today there doesn't seem to be a lot going on, and then other days there's like, wow, how can I process all this information and kind of internalize it with with what I saw yesterday and the day before and the day before, right? Again, always trying to figure out where we are as we go forward. So a couple of things, just running down the list. First off, Starbucks is coming out basically saying they're going to see below their double-digit target of growth, which is hitting their stock. I think this is interesting for a couple of reasons. I think it was last week sometime I talked about Starbucks being an indicator of the consumer, and that at least at the time their CEO sometime in August was saying, hey, there's no signs of a recession. And I remember giving it props and going, hey, okay, if people are still buying their $5 lattes and all of that, it's probably a good indicator. And then you see them come out today and basically point to, I don't know, income statement, accounting things. For example, they said the one-time tax benefit in 2019 will is not there in 2020. They talked about repurchasing $2 billion in stock this year versus next year. And it kind of feels like, again, one guy's opinion, the numbers are being managed and they can't quite pull all the levers. So what I'm taking from this is maybe the picture isn't as rosy. Maybe they thought they could manage themselves into continuing their run of growth, and maybe there's just not there. They didn't come out and say explicitly, we're lowering top line. What they were indicating is there's some balance sheet and income statement adjustments that won't be there in 2020, and thus, growth is going to be less than they want, right? The 10% target. I just think that's interesting. I think the timing is suspect. Again, I think it was less than 2 weeks ago the CEO was out saying, nope, no problems here. I think I remember giving him props because he probably had daily, if not hourly, updates right on his computer, if not his phone, for heaven's sake. So I was like, hey, if he's not seeing it, here we go. But kind of feels like he is seeing it now, or maybe his people said, hey, you're looking at the wrong chart. I don't know. Just seems odd to me. And again, not a stock guy. Will never be a stock guy. It's all these, you got market risk, industry risk and company risk, and just too much for me. So it's just interesting. One of the things I really dove into today, there's a gentleman named Michael Burry. He is the individual who sparked the Big Short movie. He was one of the first individuals to kind of short all the CDOs, collateral debt obligations and synthetics of the 2008 ilk that just blew up and took down Bear Stearns and others, and Washington Mutual and Bank of America and all these other entities that were once massive were gone. So to hear him talk about the next bubble that he's found, frankly, scares me, right? He's got a track record of one, at least that I know of, but still it was a massive win for him. This one's interesting, right? He talks about passive investments. And I'm like, what does he mean by passive investments? So this is basically index funds and ETFs. And basically what he's saying is, hey, when you need to get out, the exit doors are only so big, but there's more and more people piling into the theater, which makes sense, right? This is, and we've seen some signs of this over the years, right? I remember one big drop. It was quote unquote blamed on the computers. I think it was 800-point drop, and this was years ago. But I can see what he's talking about, right? If we kind of get cracks in the system, and the basic consumer says, I want out and I want out now, and they sell their index funds, it could cause a massive sell-off, right? And this is his point, right? Just like the CDOs of the synthetics and all these things that were layered on top of each other, right? The original bonds that kind of came out of real estate investing were okay. It was all the collateralized debt and the tranches and all these other pieces that they layered on top that became the problem. And I'm not smart enough, or nor have I researched enough to see if that's what's happening in index funds today. But if it's anything close to that with layer on layer and risk on risk, we have a mild hiccup in the economy but people get nervous and go to cash, it could cause a massive sell-off in stocks. We're talking, shutting the market down early and, all of those things. So, um, when Michael talks, Michael Burry, again, to give him credit, when he talks, I think we should look ourselves in the mirror and see, are we in that theater, to use his analogy? And if we are, should we walk calmly to the door and get out before somebody screams fire? Right, that's the talk there. It looks like the Dow jumped a little bit at the open. At least the initial impression was there's a progress in Hong Kong, right? I've been talking about South America, Hong Kong, Europe, being things we have to be mindful of because this is an interrelated economy. And it looks like Hong Kong has taken some steps to remove the tension that caused the initial protests. So again, uh, this fire is not out yet, but at least some people are pouring some pretty significant water on it, and it could go the right direction and just be a non-factor in days, is my hope. But like all fires, one backdraft or one thing can spark, and suddenly it's front and center and never worse. So, um, my hope is peace is done, and it moves forward, and we don't have any flare-ups. Another one, the last one I sort of caught my attention today, is the New York President John Williams is indicating that low inflation is the problem of our era. And I think that's interesting, right? If low inflation is the talk of the town, and he's the New York president for the Fed, so he has some clout. I just wonder what that means, right? If they really believe that low inflation is the problem, full employment, which is where we are, it kind of just screams to me that they're going to lower interest rates. And again, I go back, I think I called it earlier. I still suspect they might lower by a half a point at their next meeting instead of just the quarter that the market fully expects now. I think they have intentions of sparking people to borrow and not save. We talked about, I think it was 2 weeks ago, there was a company that bought another retailer because debt was cheap. And I think they want to do that. I think they want to spark people to consume, to borrow, to buy assets. And if you happen to own assets in an environment like that, where they're increasing the demand for them, typically prices go up. So, the owner of assets, the owner of real estate should be, benefited from this. And oh, by the way, like I've said before in these videos, in 2020, probably early 2020, I'll be refining some debt, increasing cash flow some more. So I don't see any reason not to believe that lower rates are in our future. So in the end, today was an interesting day. Michael Burry's The Big Short sort of calling out ETFs and index funds as a problem. Scared me, even though I have nothing in the market, still scared me because I saw what happened to other people, and I'm hopefully try to be a good person. The Dow jumped because of Hong Kong. I really hope that kind of risk goes off the table. The black swan that could have been goes away. And then the Fed talking about, again, the New York president talking about low inflation being a problem. And of course, as we started off, Starbucks seemingly saying 2 weeks ago, not a problem, now saying could be a problem. So interesting day, and I look forward to seeing what tomorrow brings. All right, everybody, have a great day. Take care.